Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Pan American Silver stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, $7 billion market cap. They're trading at $19 a share, and they have 368 million shares outstanding. Pan American Silver is a mining company based in Canada with operations in Latin America. They have mines and other projects in Mexico, Peru, Bolivia, and Argentina. They are one of the world's biggest silver producers, but they also produce gold, zinc, lead, and copper. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looked good in 2020, 284 million. It dropped to 149 million in 2021. Then a big negative in 2022, back to positive in 2023. Their numbers are a bit volatile. It does make it hard to value. Their dividend yield is 2%, which means they pay out 145 million in dividends for the year. Their free cash flow is half of that. So something has to give. They need to generate more free cash flow or cut their dividend. In 2020, they generated a good amount of free cash flow, more than enough to cover their dividend. 2021 was almost identical to the dividend. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's positive in 2020 and 2021, negative in 22 and 23. Revenue is a sales for the company, and that goes up from 1.3 billion to 2.3 billion. It dipped a little from 21 to 22, down 8%, but up 55% into 2023. Their revenue per share is $6.29. One share price is $19, so your piece of the company is $6.29. But the free cash flow generated per share is only 19 cents. We estimated 4 years of future free cash flows. We also estimated the terminal value, which law cash flows past year 4, that's $6 billion. We discounted those numbers back to today using the weighted average cost of capital. Here's the WACC, 9.5%. And we get a value of the company of $5.3 billion. We divide that by 368 million shares. And we get a calculated stock price of $14. They're trading at $19, so they're trading at a 31% premium. It's a sell according to the model. But the stock price is highly dependent on the price of silver and the price of gold. They're actually in the industry gold, not silver. There's only like 3 companies in the industry silver. I guess if you sell any gold, you're in the gold industry. There are 44 companies in the gold or silver industry. And if Pan American has a number in red, they're worse than the median. If they have a number in blue, they're better. They spent 375 million in CapEx, about the average. Barrick Gold spends the most, 3.1 billion. A good debt to equity ratio, 0.2. For every dollar of equity, they have 20 cents of debt. They pay a 2% dividend. B2 Gold is number 1 at 5.5%. Then Newmont, 4.1%. They don't generate much free cash flow, but it's positive. It's better than the average. Agnico is number 1 at 930 million. They rank 9th in market cap. They should be 9th on this list. I'm not sure why they're 7th. Their price to book is equal to the median. We can't look at their PE. They have negative earnings. They trade at nearly 100 times free cash flow, which is not a good multiple. 3 times revenue, which is good. That's equal to the median, a lot better than the average. A lot better than IM Gold. A little worse than Newmont and Barrick. They generate 1.7 billion of revenue, a lot more than the median average. A lot more than number 1 in the industry. Triple number 6. And their revenue is growing quite a bit. Their 5-year annual revenue growth rate is 24%. Look at Equinox, 105%. If you put $10,000 into this company 10 years ago, after a year, you would have been down 50%, and you probably would have sold and been pissed off. But if you still held on, your $10,000 would have been over $25,000 in about 2021, 7 years after your initial investment. But it has come down a lot since then. You would be up 74% from your $10,000 investment. It would be 17,400, which isn't terrible. This blue line is Pan American stock price the last 5 years, and the stock is up 45%. This grayish line is the price of silver, which is up 82%, and then gold, the orange line, up 78%. But Pan American pays a dividend, so if you add that in, It's probably close to 60%, not 44%. Still, it's trailing gold and silver. In the past 2 years, gold and silver are up 8% and 18%, but this stock is down 36%. This stock is the blue line. In the past year, this stock is flat. Silver up 9%, gold up 16%. Year to date, silver and Pan American are both up 17%, gold 13%. But in the past 3 months, this stock is up 24%, which beats silver and gold. So they don't track each other that well. There is some correlation, but not as much as I thought it would be. Let's take a look at their fourth quarter report. Here's their outlook for 2024. They plan to produce between 21 million and 23 million ounces of silver for all of 2024. About 5 million in the first quarter, 5.5 million in the second quarter, about 5.7 million in the third quarter, and also about 5.7 million in the fourth quarter. Gold production 880,000 to 1 million ounces. And they estimate the cost of silver to be between 1170 and 1410. The all-in cost between 16 and 1850. Gold cash cost 1165 to 1260 an ounce. The all-in cost between 1475 and 1575 an ounce. When you see AISC, or all-in sustaining cost, this shows us the total cost of producing 1 ounce of gold or whatever commodity you're looking at. It includes all direct costs such as labor, materials, energy, taxes, royalties. Their shares outstanding at the end of 2022 were 210 million, and now it's up to 365 million. Usually when shares increase a lot, it's due to acquisition. Fourth quarter revenue, 670 million. That's up from 375 million. For all of 2023, 2.3 billion, up from 1.5 billion. Operating earnings, 300 million, up from 48 million. But they still have a net loss of 100 million, which is better than last year of 340 million. In 2023, they produced 20.4 million ounces of silver. That's up from 18.5 million ounces. Gold improved 550,000 ounces in 2022, 880,000 ounces in 2023. Zinc, lead, and copper pretty much flat from 2022 to 2023. So these are their 5 main commodities: silver, gold, zinc, lead, and copper. I'm really bullish on copper. I think that's going to go up the most because there's so much copper needed in the infrastructure for EVs and a lot of green energy. The all-in cost for silver went from 1648 to 1817 an ounce. The all-in cost for gold went down from 1649 to 1371. By the end of 2023, gold was higher than the end of 2022, but the all-in costs went down. That's kind of interesting. I chose it right here. The average price for gold went from 1800 to 1950. Silver went up a little bit. Zinc went down a lot. Lead was flat. Copper went down a little bit. These are the prices in the open market. Here's their income statement for the fourth quarter. Revenue of 670 million, up from 375 million. Expenses of 600 million. Most of that is production costs, 440 million. Then you have lots of operating expenses, general and administrative, exploration, mine care and maintenance, impairment, the biggest one, 36 million. That's when you write down the value of an asset on your balance sheet and pass through a loss onto your income statement. When you depreciate an asset, it's normal wear and tear. Impairment is more extreme. Like you depreciate your car each year, say $2,000 a year for 15 years. But if your car gets totaled, then you would impair it and write down the whole value of the car. So they have an operating loss of 27 million compared to 148 million last year. They used to have an operating gain like in 2020, 2021. So their expenses are getting pretty high. They need to fix that. And here's their fourth quarter statement of cash flows. They do generate positive operating cash flow, positive 167 million. So maybe it's not that bad. They had a ton of depreciation, 140 million. That's a non-cash expense that brings down your net income, but we add it back here. They also had a $56 million cash inflow from working capital. So if they use accounts payable, that's a cash inflow. But when they pay back those accounts payable, it's a cash outflow. And when you buy inventory for your business, it's a cash outflow. But when you sell the inventory, it's a cash inflow. It might sound a little confusing, but I did a video connecting the financial statements that explains this in more detail. They spent 119 million of PP&E, 70 million in the fourth quarter of last year. In their financing section, they paid 36 million of dividends, about 50% higher than last year. They added 10 million of debt. Last year they added 160 million. If you follow this company, I'm sure you're aware of the Yamana acquisition. In March 2023, they acquired 100% of this company. And that's why Pan American diluted their shareholders so much. They issued 154 million shares. That was worth $2.8 billion to the former shareholders of Yamana. Since Pan American owns 100% of Yamana, they consolidate that company's operating results into theirs. So all of Yamana's revenue, all Yamana's expenses, all their debt are part of this company's financials. They also divested Mara to Glencore. And it talks about it in this article. Glencore paid $475 million to Pan American. So now Glencore has assumed 100% ownership of the Mara project. They also divested other assets, a 92% interest of a mine in Peru, and some other things. It's right here on the next page if I just waited and looked. Glencore paid $475 million in cash to Pan American. For the Peruvian mine, Pan American received $29 million in cash. They actually produced 20 million ounces of silver, which is below their outlook. They forecasted 21 to 23 million. They did hit their gold target. They actually produced 880,000. The forecast is 870 to 970, so the lower end of the forecast. They fell short on zinc. They hit their lead target, and they hit their copper target. Their all-in costs for silver are higher, 1817. The target was 14 to 16. Gold, they were on target, 1371, which is between their forecast. Here's their statement of cash flows for all of 2023. Earlier, we just looked at the quarter. So for all of 2023, it looks pretty good. Operating cash flow of $450 million. That's up a lot from last year of $32 million. Even though they had a net loss of $100 million, they still generated $450 million of cash flow. In the investing section, you could see all the acquisitions. $379 million of PP&E, a cash inflow of $259 million from Yamana Gold. In the financing section, they paid $130 million of dividends, $95 million last year. They added $315 million of debt, paid down $700 million. Let's take a look at the stock on Simply Wall Street. Its last price 19, 7.1 billion market cap, up 9% in the past week, up 2% in the past year. Let's see what they say about the company. Pan American engages in exploration, mine development, extraction, processing, refining, and reclamation of silver, gold, zinc, lead, and copper mines in Canada, Mexico, Peru, Bolivia, Argentina, Chile, and Brazil. They were formerly known as Pan American Minerals Corp., and they changed their name to Pan American Silver in 1995. Incorporated in 1979, headquartered in Vancouver, British Columbia, Canada. It looks like they started trading in 1995 at $5.63 a share. Its lowest point was in 2001, between $2 and $3 a share. And you could see how volatile the stock is. It ran up past 40 in 2008, then down to $10 at the end of 2008, back up to 40 in 2011, down to $6 in 2015, back up to 40 in 2020. In the beginning of this year, it was as low as $13 a share, but it is coming back up. If the price of silver or gold goes up, this stock should go up. Simply Wall Street's valuation is $12. They say the stock is overvalued. Two analysts priced this stock at $23. The revenue forecast for 2024 is $2.65 billion, 2025 $2.8 billion, 2026 back down to $2.6 billion. And the free cash flow forecast for 2024 is $200 million, 2025 $400 million, 2026 down to $348 million. You can see their revenue has come up a lot since 2013. It was a little over $900 million, and then it was pretty flat for the next 5 or 6 years. Then it jumped up to $1.5 billion in 2020, still around $1.5 billion for the 12 months ending 3/31/2023. Then with their acquisitions, the Yamana acquisition, it's come up to $2.3 billion. They manage a pretty good balance sheet. This red line on the bottom is their debt, which is always pretty low, at least low relative to their equity. Their equity is $4.7 billion, their debt is only $700 million. And this green line is their cash. So they don't keep that much cash on their balance sheet. Here's their dividend since 2014. It peaked at 5.3% in 2015, and then it came down to 0.3% in 2016. It was up to 3% in 2022, but the forecast is 2.1% for 2025. The CEO's salary in 2017 was $700,000. Now it's about $1.1 million. Total compensation $7.1 million. Tenure as CEO over 9 years. In the past year, there's been some insider buying, no selling, and 58% of the company is held by institutions, 40% by the general public. The biggest shareholder is Van Eck, the New York City investment manager. They own 13%. Then BlackRock, Vanguard, Fidelity. Another New York City company, Slate Path Capital, TIA Cref, the Norwegian bank, Norges. Then you have Morgan Stanley, TD Asset, Manulife. Their employee count was higher in 2013, 7,300. It came down to 4,000. Now it's 6,200. And the ticker trades on the New York Stock Exchange, TSX, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and the Buenos Aires Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below if you'd like to get a custom valuation or just support the channel. You can become a member by clicking on the link in the description below. Thanks for watching.